Let's begin with a global voice. Margret Yan of CMC Markets is joining us right now on the show. Margret, thanks very much for taking out the time. Global markets seem to be rejoicing the fact that, there could be some positive news around the trade talks between the US and China. But how short-lived do you think this could be?
Hi, good afternoon. Yes, today we saw a broad rebound in Asia equities as well as the US futures, which is up almost 1% now into a record high. And the reason, the push factor behind this is the G20 meeting, which ended up with a positive tone in which the leaders of both US and China agreed to reopen this trade negotiation. And we also see some positive catalyst of this G20 meeting, including that US, they allow some of the chip makers to resume the shipment to China's telecommunication giant Huawei. And meanwhile, China has agreed to purchase more agricultural products from the US, although the amount is undisclosed. So this set a very positive tone for the continuous talking of the trade talks between the two countries, and the market is welcoming this decision. In the meantime, the expectation for a Fed to cut interest rates by end of July still remains very high, nearly 100% as indicated by the futures market. And one more thing is the oil price. We saw today that crude oil prices advanced nearly 2% because Russia and Saudi Arabia leaders, they have reached agreement to extend the cut until the end of this year. So oil prices are boosting the energy stocks across Asia.
Margret, my question to you was regards to the equation between crude and equity markets, and if we indeed anticipate crude oil prices to strengthen more from here, would that mean some amount of profit taking in the equity markets, and would you then see equity markets coming off their record highs?
Well, yes. My concern is that even though there's a broad positive sentiment driven by G20, the trade, as well as Fed cut, but this rally in global equities might be overdue, and it is starting to derail from the fundamental picture. Because on a Sunday, we saw China PMI reading came below expectation and extend the second month of contraction, and a broad decline of manufacturing activities were observed across Asia, Europe, and Japan. So this fundamental picture is definitely weakening, and outlook remains very soft. And tonight we will see U.S. manufacturing PMI, which is expected to drop from the last month's reading as well. So I'm not sure if this rally is sustainable and supported by any fundamental reason. Another risk is the outlook of U.S.-China trade talk. Although they set a positive tone, but in the G20 meeting, there's lack of detail of what has been really agreed between the US and China leaders. And also the key deadlock of the trade negotiations, such as the structural reform and the technology transfer, all these key issues will remain unsolved. And I think a divergence still exists between Washington and Beijing on those issues. So there might be a point of time in the future that trade tensions re-escalate and surface to be a big market interrupter. I don't know, this may happen in a month or 2 months' time or end of the year. So the trade remains a big uncertainty for equities outlook.
Margret, what's the bet on the dollar and the dollar index? Because the dollar index was showing signs of coming off, as a result of which some EM currencies, including India, were doing reasonably okay. What is your near-term bet there?
Yep. Today we saw a big jump in the US dollar index, and that was mainly due to the weakness in euro as well as Japanese yen, because there was a broad risk-on sentiment which pushes US dollar higher, and that exert pressure over emerging market currencies. But in the mid to long-term outlook, I think dollar will still have more downside pressure given a very dovish Fed as well as the White House. So President Trump has mentioned many times that he wants to keep the dollar weak in order to make U.S. companies and exports more competitive in the global market. So now we are seeing a new wave of competitive currency depreciation among the central banks. And because of Fed, which is a dominating central bank in the world, I think the dollar will have more downside to go, even though there might be some technical rebound in the short term.
Sorry, did I hear you say that there could be some downside to gold?
Yes. I mean, in the mid to long term, the outlook for dollar remains to the downside, I think. And that is actually a good thing for emerging markets, because for emerging markets investors, we don't want to see dollar strong. That will pull capital out of Asia. And if dollar is softening, capital may flow back to Asia risk assets, sending their currencies and equities higher, so which is not necessarily a bad thing.
Right. One last question from me, Margret, and that is, we've spoken about the equity markets, we've spoken about emerging market currencies. Let's talk about the implications of what's been happening globally on the commodities market, and whether or not global commodities will start to look, as a brighter investment opportunity compared to the likes of equities, if there is anything meaningful that comes out of these trade conversations.
Well, commodity market is very broad, so we can probably divide this question into two parts. One is the energy sector, another one is the precious metal. So I think these two sectors will have very different performances in the next couple of weeks. I'm very bullish on the crude oil prices. I think technically and fundamentally, the oil prices will likely to move up further, and there are three reasons behind. First is a soft dollar outlook, which is supportive to commodities prices. The second is that OPEC and Russia, they have made an agreement to extend the production cut, and also with Iran's sanctions, which curb the oil supply in the Middle East, that's less likely to provide some support to oil prices to go up further. And last but not least, if you look at U.S. commercial oil inventory data, that data has dropped for 2 consecutive weeks by a very big amount. So it shows that the U.S. demand is picking up, especially in the summer driving season, which is seasonally a high demand season for crude oil. So all these factors adding together, I think oil will have more room to go up. On the other side, we look at precious metals like gold. I think technically gold has been overbought and is now into a consolidation or correction phase. And also because of G20, post-G20 effect, there's definitely a demand, a reduction of demand for safety. So today we saw gold price tumbling nearly 1%. And I think there would be more room to go down further for gold.
All right, Margret, we'll leave it at that. Thank you so very much for joining us this afternoon with your thoughts.